Global markets delivered mixed, but generally resilient outcomes over the December quarter, as investors navigated shifting expectations for interest rates, valuation pressures, and ongoing geopolitical uncertainty. Early volatility gave way to steadier conditions towards year-end, supported by the US Federal Reserve's December rate cut and continued confidence in corporate earnings. Of note, in December we saw a rotation into more economically sensitive cyclical sectors, such as financials, materials and commodities, suggesting that the market has an increasingly optimistic outlook for the global economy in 2026. Australian shares were volatile over the quarter, ultimately finishing modestly lower. Stronger than expected inflation and economic data led markets to reassess the outlook for monetary policy. However, support from materials, underpinned by firmer commodity prices, helped cushion broader market weakness. Fixed interest markets delivered mixed outcomes over the period. Global bonds stabilised as central banks adopted a more dovish tone, supporting returns towards year-end. In Australia, however, rising yields weighed on local fixed interest as expectations for near-term rate cuts were pushed back. Credit markets remained supported by resilient corporate fundamentals, with high-yielding segments benefiting from the ongoing demand for income. Looking ahead, the macro environment remains broadly supportive. Global growth has proved resilient, inflation is moderated across major economies, and corporate earnings momentum remains solid. Against this backdrop, several opportunities remain evident. Firstly, investment linked to AI remains a structural driver, with unprecedented capital spending driving economic growth and offering the potential for productivity gains over time. Second, interest rate sensitive segments, including global small companies, infrastructure, and property, are still trading at reasonable valuations and should benefit from stronger growth and any further monetary and/or fiscal easing. At the same time, risks remain. Equity valuations are elevated, leaving little room for disappointment should earnings momentum slow. Unpredictable geopolitics has the potential to create ongoing volatility and risk, as demonstrated by recent events in Venezuela, Iran, and Greenland. And finally, the risk of excessive investment in AI may also contribute to periods of volatility. In this environment, returns are likely to be more uneven and selective, reinforcing the importance of diversification, discipline, and an ongoing focus on fundamentals as investors navigate 2026.